So silver's now lost about 20% from its recent highs, near $50 an ounce last week. Gold also notching a 3-day decline, in fact the worst since January. And it was all despite that broad US dollar drop that we saw. So let's get across to Jonathan Barrett from Commodity Broking Services, who joins us in Sydney. Jonathan, the question is, with silver being 20% cheaper than just a couple of days ago, does it find a floor? Do you get buyers come in, or is there more pain to come?
Well, I think from a general perspective, when we saw the meteoric rise that we had prior to this, I think a lot of us in the market said we're not going to buy it and we're certainly not going to sell it. I think with the fall from 20%, I think it's prudent to say that I think we were right. We didn't have many positions in the silver market just due to the volatility, and as you can see, I think that bubble has been pricked for silver, seeing that massive decline. It has been just a run for the doors as people try to exit and try and grab what profit they can on their long silver positions.
And I think there's also been reports that there might be some more changes to their margin requirements even Friday and then again on Monday. Is that what you're hearing?
With these sorts of volatility, with this sort of volatility going through, Brooke, yes, you've got to expect it, because a lot of people in themselves are getting themselves hurt because the margins aren't sufficient to meet the daily volatility. When you're looking at swings between 7 and 8%, it all started on Monday when we saw that massive move at 11% during Asia, and I think the exchanges are doing the prudent thing by pushing up these margins, which are allowing people who can trade it correctly without getting financially hurt.
What's the knock-on liquidation pressure that you're seeing as a result of that? People have been talking about it. Are you seeing that in droves, or in terms of maybe gold and oil?
No, not really. When you look at it, if there's any I guess change in margins, they're only small, so there's no knock-on effect from that. But in terms of the whole precious metal complex and also oil, we're seeing this question, and I'm glad Phil raised it in the previous interview, because people are starting to question that ability of this recovery. And that's a big question. And what can the Fed throw at the market now? Is it a QE3, or is there some other type of monetary program? Because we're clearly not seeing the numbers that we need to ensure that this recovery is underway. Not just in the States, but we've also got those growth economies coming under pressure. So the need for commodities is not as it was a while ago, and as a result of that, we're going to see a correction, and I feel this correction will be with us for a little while to come. So
you're talking the need for commodities, which is fundamentals, but yeah. I thought commodity guys, and I mean, we've talked to Phil before, he says they love Ben Bernanke because he gives them cheap money. So as long as they've got cheap money, they want to trade and they want all these commodities to go higher. Yeah. So why today everyone suddenly says, oh, we're worried about the economy and the fundamentals? This
is the disconnect that we're talking about, and it's worthwhile having a think. Because whilst the commodities are priced in US dollar, Ben prints the money, so that's good for those commodity traders that purely run on weaker dollar long commodities, and they discount the fundamentals. And it becomes quite hard when you analyse the fundamentals when you see that people are buying commodities purely on the back of the weaker dollar. And that's wrong in the way you should price the value of commodities, but that's been the play for such a long time. And I think this disconnect has to change, because I think that commodities have to show their true value, and we are seeing that in some commodities. Commodities across the board last night came under enormous amounts of pressure due to the dollar and other things, but more important, other commodities such as corn bucked the trend. Why did it buck the trend? Because the solid fundamentals suggest that we got a concern on the supply of corn, and that's why it went up.
Yeah, perfect time to bring in Luke Matthews, who's also with us from the CBA this morning. Now, Luke, you're looking at the ag side particularly. You're saying actually ag commodities, some of them have been in a bear market for the past month.
That's right. Look, we've seen some pretty nasty falls across the ag complex over the past month, as you allude to. We've seen cotton down around 19%, sugars down around 18%, and the grain markets are down between 5 and 10%. We do need to bear in mind, though, that those declines do come off very, very high levels. Cotton, for example, it exceeded 200 cents a pound compared to its long-run average of around 50 cents a pound, and the level that it's trading at today, around 150, is still significantly higher than those long-run averages, and indeed higher than previous records that we've seen in the past. What we've seen over the past month is a disconnect between the commodity complex, the agricultural commodity complex, and the US dollar, as previous people have spoken about. This is unusual in the agricultural complex as well, but we do believe that over time the fundamentals within the ag space will reassert themselves, and we're likely to grind higher over the next 6 months for many key commodities, particularly the corn complex. Also, we're seeing significant concern around wheat production prospects for 2011, and we think those factors will help support prices over the balance of this year.
Are there any particular commodities across the soft spectrum that you're watching, Luke, that become vulnerable to demand destruction as we continue, if you're expecting prices to go even higher?
Look, we certainly have seen evidence of demand destruction across the commodity complex. Within corn, within cotton, within sugar, we have all seen a slowdown in demand. But we do need to recognise that that slowdown in demand was necessary, because without that slowdown we would have been getting very, very tight in terms of running out of corn supplies, cotton supplies and sugar supplies before the new crop came online. So that demand destruction, whilst obviously bearish for near-term commodity prices, was a welcome event in the ag space.
And Jonathan, anything from you on all of that?
Yeah, look, I tend to agree. This is perhaps a good standout opportunity on this dip that Luke's just talked about, because I actually feel that that any dip that we actually see is a good opportunity to get along and get along a lot of these commodities, in particular the corn market, the wheat and the soybean market, because those weather concerns, particularly what's happening in the Mississippi, I think is a major concern across the board. So it's a great opportunity, I think, to get along.
And so this is where the fundamentals become all important, unlike some of those other commodities that we chat with you about Jonathan.
That's correct.
Yeah.
This is what we're all sort of saying, this disconnect to fundamentals and what the dollar's doing. And you know, we're all sort of the analysts, so we're all starting to say, well, look, there is this concern, but the true fundamentals in some of these grain markets, we can see prices just starting to rocket due to the weather effects and the fact that we're not seeing that supply onto the market with the current crops. And I think that's a concern going forward. But at the moment, prices should hopefully get a little bit lower so we can get long.
And Luke, I mean, we've had in recent times Goldman Sachs, I think mid-April, say that it was turning bearish on commodities in the short term, but then more recently Morgan Stanley saying it was quite optimistic. So who's winning out of those two in that race?
Well, look, certainly the evidence of the past month suggests quite steep declines in agricultural commodity prices, so the near-term win goes to Goldman Sachs, but we still do look at the longer-term fundamentals supporting agricultural commodity prices, particularly considering that we've got these significant weather concerns on the radar. So the race isn't over just yet on that front.
Jonathan, thoughts on that one?
Look, I agree. Weather's the big key, and I think that's one of the big concerns that we're going to face over the coming 8 months.
I should specifically ask you about gold as well, Jonathan, before we finish off. How is that similar or different to what's happening in the silver market? Because often these discussions get lumped in together. Silver and gold have done this. But what are you noticing in terms of some of the differences that people should look at?
Well, I think, Brooke, when we look at the gold and the silver, we always refer to that gold-silver ratio, which we talked about a little while ago. That got down to about 32. It's currently back at 38, which suggests to me that people still want to retain that gold position over silver. Silver's had that little bit of a bubble, it's burst, but now gold still is just slowly coming back. Silver's going back quite quickly. So if anything, I think there are still concerns about that which will help gold. And I think over the two, gold will continue to be well supported on dip. Perhaps there's more on the downside for silver. So I think if anything, gold on dips, I think I still like.
And Luke, just to finish off with you, any trading thoughts about particular commodities or what to watch for coming up?
Look, certainly we're continuing to see sugar prices come under pressure. That's largely due to very high supplies coming out of Thailand. But we still do question how far those prices will fall over the next couple of months. We do believe that production concerns in other parts of the world may come to the fore, and also we may see demand re-enter that market over the coming 3 months. So we still are bullish around the medium-term prospects for sugar.
Thank you so much to both of you. Luke Matthews from CBA, Jonathan Barrett from Commodity Broking Services. Have a great rest of the week, guys. Thanks.
Thank you.